Hello, fellow RoboCapitalists. Hope you're well. Coming to you from one of my rental properties in Medellin. Hopefully, the internet connection is decent. You can hear me, and I'm not freezing, doing like the max headroom thing. Remember that guy? But I wanted to do a quick live stream just to kind of inform you guys as to what happened today with the labor market, some of the data that we're getting. And I think this is a big reason why you're seeing yields plummet in treasuries. I mean, plummet. And I think it's probably a reason why we're seeing a lot of these risk off events, meaning silver crashing, Bitcoin crashing, et cetera, et cetera. So let's go over to, first and foremost, treasury yields, because I think that tells you pretty much the whole story, right? And we go over to CNBC, make sure I'm doing a screen share, which I'm not. There we go. So we go over to CNBC, and let's just go over to bonds. Look at this. It's down, well, it's down a lot more than that today. Let's look at, this is after the close, but let's look at the one-day chart. So we look at this, guys. It's down almost 10 basis points today, the 10-year treasury. That is huge. I mean, that is a huge, huge, huge move in the 10-year treasury. And let's look at the 2-year. The 2-year was down massively as well. Let's see. One-day chart. So we started, let me just refresh for you guys. So we started right around, call it 3.55. So we're down maybe 9 basis points here. I mean, that's a massive move in the 2-year. Got a little bit of a steepener. We were talking about that earlier. So what did this? I think what we've got to look at the good old calendar. And when we go over to Market Watch, we see that we did get some labor market data today. And first and foremost, I think when you combine the labor market data that we received today, which kind of shocked the markets, it was like kind of the smelling salt. We're like, whoa, the economy's not booming. What? Oh my gosh. But you combine that with the 22,000 that we got yesterday with ADP, and this is a terrible number. And people who are kind of bullish are arguing that, well, yeah, there's no one that's really being hired, but no one's being fired. So we're just in this stagnant period, and that doesn't matter. No, that matters a lot. In an economy where the population is growing, if you don't have job growth, if it's just stagnant, if it's flat line, let's say it's just zero for the next 5 years, that means your per capita GDP is going to plummet. Your standard of living is going to decrease. So if you don't have significant job growth, I mean, that's a big, big, big problem. Even if you have, the illegals going back to Mexico or wherever they came from. And by the way, this is just the ADP. When you look at the non-farm payrolls, they're not just stagnant, they're decreasing. They're actually negative. So in no world do you have negative non-farm payrolls and you have booming real GDP. Those two don't blend. That's oil and water. But then today we get the initial jobless claims, which came in at 231,000. The expectation was 212. Last month we got 209. Now, to be clear, 231, although it surprised the market, it's not catastrophic. It's not like it came in at 300 or something. Not a big deal, but look at the JOLTS numbers. The JOLTS numbers came in today, I think delayed because of the partial government shutdown, and they come in at 6.5 when the expectation was 7.1. That's a huge miss and a decline of 400,000 since the last print, which was 6.9. So you got the job openings declining massively. You've got ADP coming in at 22, which is a terrible number. You got initial jobless claims spiking. And in addition to that, when you look back, you have an average, according to the Fed, of negative non-farm payrolls. That means you have a severely weakening labor market. And when you have a severely weakening labor market, that's income. That's income. And I know a lot of people also say that, well, this is just because of productivity gains because of AI. Okay, maybe, but that doesn't mean that it doesn't negatively impact GDP, because you got to think that one through, right? So let's just take it to an extreme so we can all get our head around it. Let's just assume for a moment that AI took every job tomorrow. So tomorrow there's no more jobs, but the productivity gains would skyrocket because the AI, the robots and everything, they'd be making all the stuff, right? Well, that stuff wouldn't be free because you still have input costs in the form of scarce resources such as energy. Like, no matter how cool AI is, or how much the robots can do, we don't have free energy yet. So even if they're doing all the labor, you still have input costs. So there's still a cost to that good or service, even though the cost would go down, right? In a free market, all else being equal. Well, great. If no one has a job and we haven't instituted UBI yet, well, where do they get the money to buy the stuff? They don't have it. So it's great that all the robots are making the stuff, but you don't have any customers. So now, obviously, I'm taking it to an extreme, but that's just to do a thought experiment to understand that even if this declining non-farm payrolls, let's say, is contributed to AI and that's increasing productivity, well, that's fine, but that's coming at the expense of the employees that are your customers. So if you have fewer customers, but yet productivity gain, well, fantastic. Who are you going to sell the stuff to? See, that's the problem with that argument. That's the problem with that argument. And I think that when you take one of these numbers in isolation, it's not that big of a deal. But when you combine the three of them together, the ADP print at 22,000, the initial jobs at 231, which is a low number, but the expectation was for 212, last month 209. So you're starting to see a ramp up. And then you get to 6.5 million. That might, I don't have a chart in front of me, but I don't remember seeing a JOLTS numbers that low in maybe since the cerveza sickness. That's a really low number, really low number. So as a result, you get what you see in yields, where the 2-year treasury is saying, oh my gosh, the labor market's deteriorating. Therefore, 2-year treasury, they're front running the Fed. They're front running the overnight rate because they're looking at the Fed saying, okay, you've got a dual mandate. You've got labor market and then you've got inflation. Well, if you've got the labor market deteriorating like this, you don't really need to worry about inflation too much because naturally you're going to have disinflation. And a lot of people think that you can still have inflation if the incomes are going down, if the labor market's going down. And you can't have sustained inflation. You usually have disinflation. Why is that? Because even if your input costs go up, let's say commodity prices go up for XYZ reason, supply shock or whatever, you can't pass that savings onto the consumer. And even if you try to pass that savings onto the, or that increase, onto the consumer, what happens to your volume? Your volume goes down. This is why inflation is always and everywhere a monetary phenomenon, just like Milton Friedman said. Because to have sustained levels of inflation where prices are going higher, higher, and higher, and higher, and higher, you have to have additional money supply because that creates additional wages that are therefore able to pay the higher prices. And then the companies are able to continue to raise their prices and not have a hit to the volume. But if you're not increasing the money supply, if wages aren't going up, if wages are actually going down, then you can only increase prices to a certain point where it starts impacting demand, and then you have to start lowering those prices. And if you get to a point where you have no more margin left, then the only thing you can do as a business is start to fire people. And then that decreases aggregate demand even further. And then you say, well, we have all this money printing with the Fed. Maybe they'll start QE. That's fine. But at the end of the day, that doesn't really impact, in and of itself, that doesn't really impact M2 money supply materially. Now, it can, if they're buying from non-banks, let's say, but you got to look at a global economy of 120 trillion. You got 75 trillion of dollars out there that are lent into existence. So let's just say the Fed does 20 billion of QE per month. It's just a minuscule drop in the bucket that at the end of the day doesn't really mean anything, especially when you consider even if all that 20 billion is increasing M2 money supply, you have to cross-reference that or reconcile that with the fewer amount of loans that are being produced, and that can easily be a wash, if not still be a net negative number. Because let's remember, if there's $40 billion worth of loans being paid off on net, and the Fed is doing 20 billion of QE, and they're just happen to buy all from non-bank entities, you're going to have a 20 billion increase over here, but you're going to have a 40 billion decrease over here. So on net, you still have a decrease in the money supply of $20 billion. You see? And so why would banks lend less? Because the economy sucks. There's no one to lend to. They have to increase their lending standards, even if interest rates are going down. Because remember, interest rates are a reflection of the economy. They don't really control the economy. So I think this is something that we really, as prudent investors, we really need to pay attention to. I've been pounding the table on this nonstop for the last, 6 months, year, that it's all about the labor market, stupid. It's all about the labor market, stupid. It's all about the labor market, stupid. And we just see this continued deterioration. And so tomorrow, I'm really interested to see how this plays out, because I think this is why the marketplace as a whole has gone risk off when they were just way risk on, like mega risk on, let's just say a week ago. And by the way, we had the non-farm payrolls that were supposed to come out tomorrow, and I believe they are delayed until next week. So that's going to be a huge number, because if that underperforms, let's say, if that's lower than expectations, and you combine that with all of the poor labor market data that we just went over, I think that's really going to be kind of the right hook from Tyson in terms of risk off and therefore in terms of yields. And I would not be surprised if the dollar went way up today. Yeah, it did. So it's risk off, risk off, risk off. And we go over to, let's see here. Let's go over to Bitcoin, which is down big, but it's getting a bump because Saylor's talking right now on the MicroStrategy earnings call. And of course, he's pumping. It was funny that I was watching it, and the first slide that he showed was Donald Trump. He's like, Donald Trump is a Bitcoin president, and the politicians, they're all for Bitcoin. So you go out there and hodl, buy Bitcoin, and buy MicroStrategy. And I'm like, okay, I don't know that that's a bullish argument, because they were very bullish on Bitcoin throughout 2025. And look what that did. So just think what the Bitcoin price would have done if they weren't bullish. The politicians. Would it have, I don't know how much it went down. I think it went down maybe 25% over the last year. What would it have been down? 50%? 70%? And what would MicroStrategy be? So I don't know that that's an actual bullish argument, because even though you can have the president gung-ho Bitcoin reserve, crypto reserve, all these things, his sons are out there pumping crypto. He has his own crypto. He's the crypto president. And even though he's the crypto president, crypto's down, I don't know, since inauguration, but over the last 6 months, crypto's down massively. And over the last 2 weeks, it's lost like $2 trillion in market cap. So just because you have a Bitcoin president, that doesn't mean that the price of Bitcoin goes up. Again, it's all about the marketplace, and no politician controls the marketplace. They can for short periods of time, but over the long run, it ain't going to happen. So now let's go over to look at silver. Silver's down to $70. I think it was trading in the 60s. But this isn't, in my opinion, it's not really a knock on silver. It just shows you how much everyone's risk off. And I think that's directly because we're starting to see more cockroaches. We talked about that on a few videos. And you're starting to see really poor data in the labor market. And everyone's starting to, I think, realize what we have been, realized because we pay attention to interest rates, we pay attention to the yield curve, we pay attention to these things. What we've realized for the last year at least. So you can see the drop today, but then it looks like after hours, you have an even bigger drop where currently it's trading at 670, excuse me, but we'll have to see what happens throughout the night. Now, I've been doing some technical stuff, technical analysis stuff with you guys, and I want to actually show you guys the candlestick today for SLV. We'll just use that as a proxy for silver. So you guys know we had this huge gap down, massive. And then we had this big trading range, which we have seen consistently for the last couple of weeks. And then it went all the way up here. Then it went all the way down here. Now, we had a very bullish midday. We had very bullish move in silver where people were really buying the dip and it was going up, 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 up. And we had this green candlestick. But then going into the close, it just went way down and sold off. That's not a good sign. That's not a good sign. Where midday, when I saw all this buying in a green candlestick, at this bottom of this massive decline, I was actually pretty bullish. I was like, wow, if it closes, close to the high of the day, that's a real bullish sign. But unfortunately, if you're bullish silver, it did the exact opposite, which to me is a bearish sign, at least over the next few days. Who knows what it does tomorrow. But the main takeaway here, guys, is we're starting to see obviously a lot of risk off. I would really, really pay attention to Michael Burry's thesis or hypothesis on the Bitcoin death spiral. And that's where the price goes down and all these entities that have dollar-based liabilities, they are forced, maybe not MicroStrategy, but others are forced to sell that Bitcoin to meet their dollar liabilities. And that further puts downward pressure on the price, which makes more corporations, more entities have to sell. And then sometimes they have to sell Bitcoin, but sometimes they have to sell anything. And that could be a reflection of what we're seeing in the price of gold go down and the price of silver go down as well. All right, guys, lots going on, a lot to talk about, that's for sure. So as always, make sure that you are paying attention to this stuff. Make sure that you're standing up for freedom, liberty, free market capitalism. And I'll see you on the next video.